The Indian markets have been quite volatile this week. Before the Fed announcement came through, the Indian market saw some deep cash, but after the Fed announcement has come through, where the Feds have indicated to get long-term benchmark rates between 0 and 0.25, the Indian markets are rallied. Again, I think the kind of Chinese investments push into India of around $20 billion fueled the rally further. However, I think our take is that when you look at the Indian markets in a broader context, IT and pharma have done exceedingly well, and when it comes to valuations, Indian markets are trading at 2.7 times price to book. Now, if we do a simple comparison on the last 10 years average, this is leading at average valuations or reasonable valuations. And if I compare that to peak valuations during the bull run, the Indian markets traded at a price to book of almost 4.3, 4.4. Though there is a long way to go, our take is that the corporate earnings are still subdued. I think inflation data has not softened enough. And again, the IIP data was a disaster. So having a look at all these parameters, this is very difficult for RBI to lower interest rates. And that would create a dampener in terms of credit growth going forward as one of the parameters for the lending push that the government is looking at. Another key things that the markets are looking at is in terms of key policies and reforms, and specifically on the part of oil and gas reforms, power sector reforms, and the judgment of the coal block allocation will play an important role in the week and the weeks to come. However, having said that, our take is that the oil and gas reform probably might come through, but important structural reform processes like GST would probably take time. It is only after the budget that one can probably take a call on how these things are shaping up. Till that time, our take is that the markets might consolidate and you might see a lot of stock-specific action. Now, when it comes to stocks, I think the pharma companies have been very resilient in the past few quarters. Even these earnings in the last quarter have been quite good. But the valuations have got a little bit stretched for top-tier companies. What you're liking, again, from these companies is Dr. Reddy's, where we believe that there is some amount of valuation gap still left to be caught up with the larger pharma players. So our take is that Dr. Reddy's can do well even from the current levels, and probably I think another 100-150 rupees move is not being out in the stock. Similarly, I think Dishman Pharma from the mid-cap pharma space is looking very attractive. The margins will show gradual improvement in the quarters to come, with a lot of commercial orders on the CRAM segment being built up in the second half of this year. So clearly, I think Dishman Pharma is a bet that we are liking from the mid-cap pharma space. When it comes to IT, our take is that the top-tier IT companies will do exceedingly well. So Infosys on a valuation perspective, TCS, HCL Tech, Wipro, all have a decent scope to move in terms of improved market conditions in US, discretionary spending coming back, utilization levels improving, and clearly I think that will reflect both on the EBIT margins. Though I think currency is appreciated a little bit, our take is that the currency would more or less stay in a range, which would obviously mean and also looking at TCS's con call, there would be some amount of impact on the cross currency that the companies would face. But a lot of headwinds that these companies were facing, I think would slowly and slowly get offset by good utilization levels and improved order rates. So I think Infosys, TCS, HCL Tech, Wipro again remain our top picks. When it comes to the mid-cap universe, we're liking a few stocks. Again, I think Relaxo Footwear is where we're liking from the footwear industry. EBITDA margins will show good amount of improvement. I think cash flows will ensure that the debt of the company becomes almost negligible by next year. And clearly, I think the kind of foray that the company is making in terms of its retail reach and the expansion of its brand apart from Hawaii with Sparks and Flight would augur well for the company. The tire stocks have done exceedingly well. Our coverage on JK Tires has worked out exceedingly well, and Sterling Tools, and we have actually achieved our target prices. But we remain optimistic on the tire industry. We still believe that with falling rubber prices and falling and an excess supply of rubber into the market, the EBITDA margins would sustain and improve going forward. And clearly, I think tire companies will be a key beneficiary from this aspect. So we are liking Goodyear, TVS, Chakra, CAD. So investors can look at all these stocks on declines, and even JK Tires, which has run up after our report has come out. But clearly, one must wait for declines on to these stocks because it has reached a target price. Again, I think from the other universe, I think power stocks and power ancillary stocks as we think can do well. So Power Grid from the top tier names can do well with good capex and capitalization coming through. And PTC Financial Services can also do well in terms of both valuations and in earnings growth. Kirloskar Oil Engines can be a dark horse as a value pick over the next 2 years. With capex done for the company, our take is that an improved capex cycle and investment cycle will actually drive up the earnings growth for this company. So I think the markets are here to stay in a range, probably, but stock-specific action as we've been maintaining would continue. So happy investing and have a great week ahead.